So the poor man's covered call, why I love it, how you can literally make your first one today. Today I'm going to show you all of the steps on how to complete the poor man's covered call, show you some things that you have to overcome, some roadblocks and some hurdles that I see inside the comment section of people not being able to perform the poor man's covered call. I'll give you those insights as well. Some side notes and some thoughts that I've learned along the way when trading the poor man's covered call. It really is a great option strategy. What's up, guys? Welcome back. My name is Brad. I'm glad to have you here. I've made videos about the poor man's covered call before. I think actually one of them is my most viewed video. And after a year of reading through the comment section, it was definitely time for a little bit cleaner version, a little bit more step-by-step, and also to get down into that comment section and answer some of those questions that I hear over and over again about the poor man's covered call. Although the strategy can be used by beginners, I know many beginners that are using it, especially inside my Discord. I am going to assume that you know some basic things about trading options, right? What's a call, what's a put, expiration, strike prices, things like that. I am going to use that vocabulary inside this video. If you don't know and you're still learning options and you're not really sure about all those things, I have a 1 hour and 44-minute video here on YouTube. I will link it down in the description, in the comment section. Maybe I'll even pin it up here. Go check that out, learn a little bit, and this strategy will be here when you're ready to start trading it. First and foremost, guys, the poor man's covered call is kind of like a nickname, right? The option strategies, there are so many different names and things we hear, but at its core, like if you were going to Google this, I mean, I guess you could Google poor man's covered call, but all this is a diagonal debit spread. And this is different than a call spread because in a debit spread, we are going to pay more premium. We're going to be buying options in this strategy. So we are going to need to pay out premium, but we're also going to collect it as well inside that poor man's covered call. But the net is going to be a debit. We are going to end up paying more and hoping for greater returns in the future. Now, why do this as opposed to just buying an option? Well, when you buy options, you need to pay premiums, and some stocks have really, really high premiums. So what this does is it lowers the financial barrier to entry when buying options, right? If you buy an option, you have to pay some premium. Now, if that premium is a ton of money, but you can go and now sell a call against it and receive premium as credit, those two are going to offset, right? Decreasing the amount of money that you need to get into the trade. So that's why people are going to do spreads as opposed to just buying options. It really comes down to that premium and limiting the amount of premium that we need to pay to get into the option. Now, I just mentioned the credit spread, guys. There's many different types of spreads with many different names. There's vertical spreads, there's horizontal spreads, there's bull call spread. The name doesn't really matter that much. It's more the process and the goals and the things that we want to achieve inside those options. So many people want to get down in the comments and list all the technical names for the poor man's covered call. For me, diagonal debit spread is good enough. Or like I said, just Google poor man's covered call and you'll find it, I promise. So why do I love the poor man's covered call on top of just lowering the amount of premium that I'm allowed to collect? Number one, I love Leap's options, long-term equity, anticipation securities. Please, guys, when talking about Leaps, do not forget about the S. It drives me crazy. It is a pet peeve of mine. The S does not make Leap plural. It is part of the acronym. Anyway, I had to get that off my chest because I see it everywhere. Guys, I love Leaps. I love the leverage of a Leaps option. I've made videos about why I probably will never just come out and buy 100 shares outright ever again. To get the leverage of those 100 shares at a very, very small discount, I love the Leaps option. I really, really do, and that's part of the reason why I love the poor man's covered call. The second reason is I love collecting premium. I like making money.
You guys are getting paid?
So when we have this Leaps option, essentially we're going to start selling calls and using that Leaps as the collateral. We know that when we make a standard covered call, we use 100 shares of a stock we own, and then we sell calls against it. Well, this is a way for us to sell and use the Leaps as collateral and now sell calls against it. And I'll get into that in finer details in just 1 second. Okay, step one. You need to be able to trade spreads inside your brokerage, okay? And when trading options, to protect you, you often have to go in and apply for options trading or just enabling. Pretty much the easiest barrier to entry I've seen is Robinhood. Like Robinhood, you just go to investing, you scroll down a little bit until you get to options and you ask for it. They're going to ask you a couple questions. If you want to lie and put yourself at risk, go for it. But inside Robinhood and many other brokerages, you need to be able to trade spreads. All right, you're not going to call Robinhood and be like, why can't I make the poor man's covered call? No. You need to be able to trade spreads. I know that in Fidelity, I needed to do a paper application. Like, it was a big deal to be able to do that. I know Webull does not allow you to trade spreads at all. M1 Finance has no options whatsoever. So we need to make sure that we can trade spreads. And like I said, if many of us are using Robinhood, it's just level 3. You got to answer a couple questions. Be honest to protect yourself so you don't come out and hate Robinhood later after you screw yourself over. Like I said, step 1, be able to trade spreads. If you don't have this level 3 enabled, I know I get a lot of Robinhood users, they say, you'll get a message that says, do not have enough collateral or do not have enough shares to make the short call. Right? Just go in, find level 3, and you should be okay. Step 2, pick the stock that you want to do this with. Now, it should be a stock that you want to own, a stock that you've done your due diligence on. We should not be chasing premiums here, right? The premium is the little cherry on top of this awesome stock that we are going to place a leaps option on and be able to one day potentially make a lot of money off of. Now, without diving into individual stocks, because I'm not a financial advisor and I can't tell you what stocks to buy, I prefer stocks that move in a steady upward direction, right? You can follow my other videos. You can hop on my Discord. You can see exactly what I'm trading the leaps with. I update them pretty much as soon as I make those trades. But you don't want something that trades flat because that leaps option, we are going to benefit by the share price going up. So you want to find a stock that's going to grow steadily. Now, in this particular strategy, we don't want a stock that can just moon and shoot up straight because as we're going to see in a second, the short call, we don't want to put ourselves in risk by the share price shooting up past our strike price on our short call. So we want a nice, predictable, steady growth over time. You can look at the last 1 year chart, even though the last 1 year has been a little crazy, and see, is it a steady yo-yo up a staircase, or is it up and down and up and up? You don't want huge volatile stocks. Yeah, you're going to make more premium, but it's just going to be a pain in the ass. Just trust me on that. Now, this poor man's covered call can be set up in 2 steps or 1 step, but in this case, I'm going to talk about it in just 2 steps. So the next step after you have enabled level 3 and you've picked the stock you want, we are going to make the leaps option first, okay? So we are going to go into our options chain, whatever brokerage you're using, and we are going to find a strike price that will work for a leaps option. Now, some general rules of thumb, because we're going to be buying options and paying premiums, so we have to think about some things as far as what you can afford, expiration, things like that. For this leaps option and for the poor man's covered call, this is my general rule of thumb. I like to go in the money to a delta something greater than 0.75. I want to make that deep in the money. And yes, we are going to pay more premium, but once you understand how premium's made, the differences between intrinsic and extrinsic value, you know that you're really paying for some of the growth or the profit that you're already receiving by going deep in the money. So personally, me, I at 0.75 or greater. The other thing that we're going to look at in this leaps option is expiration. I want to do an expiration that is more than 365 days out. Why? First reason, it allows me a lot of time to make calls and collect premium back before this show ends. And also, too, if you profit off of that leaps option and you go more than 365 days and you hold it for more than 365 days, now you're in a long-term capital gains situation, which is awesome. For me, the higher priority is expiration. So when I'm looking at the stock that I like, I go a year out. Sometimes it's a year and a couple months, depending on the dates and liquidity. I find that year out, then I go down to the delta and I see if I can afford it. If I can't, I either have to save up some more money in premium or I have to choose a different stock. I very rarely will break one of those 2 rules to make it happen because when I've done so, I ended up burning myself. Better to be a little patient and have things work out. The more boxes that you can check inside your strategy, the more likely you are to succeed in that strategy. The more rules you break, the more likely you are of screwing yourself over. Now, step 4, like I said, you could do it at the same time that you place your leaps, or you could do it a week later. It's really up to you. But the next step is going to be placing your short call, your covered call, using the leaps as your collateral. First, the delta on my short calls. I like to be below 0.2. The reason I want that delta so low is because we need to protect the leaps. We do not want this call to get assigned. Unlike the wheel strategy, when I say I don't fear assignment, I'll take assignment all day. In this, I do not, under any circumstance, want that short call to be assigned. And as far as expiration, I want to make that less than 45 days out, right? Because we want theta on our side, just like the wheel, right? We want the premium value to go to 0 on our short call. So once we go further than 45 days out, right, theta kind of stays a little flat. It really starts to ramp up as we approach expiration. So this expiration is going to be short. Like, I'll even do weeklies if I can. I do a lot of these with stocks that only trade monthlies, so I'll be a monthly. So that's kind of the structure of the debit spread. We make a leaps option. We're going to pay a bunch of premium because it's deep in the money and far till expiration. Then we're going to make a really short-term short call, which isn't going to collect a lot of premium, guys. It's really not compared to what you paid for the leaps. But like I said, we're going to be doing this every week or every month for the next year. And what it's doing is it's lowering the amount of net premium that you paid for this overall option. The last rule of thumb with like the short call, guys, make sure that the difference in your strike times 100 is greater than the premium that you paid for the leaps option. So for example, if there is a $10 difference in strike, you need to make sure that you paid less than $1,000 for your leaps option. If you do so, you really can't lose if your short call gets assigned. Okay, if you paid $1,000 in premium and you have a $5 difference in strike and that gets assigned, you lose $500 right out the gate, plus whatever you paid. So use that as your safety net. Make sure that the difference in your strikes between your leap strike and your short strike times 100 is greater than the amount of money you paid for your leaps. Step 5 is going to be to monitor your option. And most of the time, you're just going to be monitoring that short call. Now, this short call has different rules that I apply to the wheel as well. I love to buy to close, right? When we sell options, we want to collect premium. That premium goes into our buying power immediately. Once we get to a profit that we're happy with, we get the hell out. We don't let things happen close to expiration that can screw us over. So when I trade the wheel, right, I'm going to try and buy to close at about 70% of the original premium that I collected. In this case, because like I said, I want to protect that leaps option, I'm going to close my short calls at 40%. That's just me. So if I get $10 in premium for that short call, as soon as the value of that option drops to 6, I'm taking $4 and I'm getting out of there. Simple as that. You could choose whatever percentage or threshold or risk tolerance that you want, but never, rarely ever am I going to let this go all the way to expiration. Sometimes things don't work out with that short call. Like I said, if it shoots up past that short call, there are times that you might have to roll up and out in expiration. By say up in strike price and out in expiration, and you might have to buy to close that short call at a loss. That's okay. Once again, not something I do in the wheel, but in this strategy, there are going to be times when the market shoots up and you are going to have to close that short call at a loss. Don't worry about it. It's going to be a minor hiccup over the course of a year, and that's fine. Because like I said, with the leaps, as the share price goes up, generally the leaps is going to become more valuable. So that loss that you take closing it is going to be fine because it's a good thing for our buy. It's a good thing for our leaps that the share price is going up. We just got a little screwed on our short call and we need to protect that, move it up in strike and out in expiration. With the leaps option, when am I going to close that? That's not going to go to expiration either. And under 99% circumstances, I am never going to exercise that option. As the buyer of an option, you should never exercise your option early. If you don't know why, I have a video on that. I'll leave a card for that up here. You could check that out, or maybe I'll just leave that down as a pinned comment as well. Never going to exercise the buy. So what I'm going to do about 60 days out, I'm going to look to sell to close, right? Because we bought to open. I'm going to look to sell to close, and you cannot sell to close until your short leg is gone. So you would buy to close your short leg, leaving only your leaps, and then you will sell to close, like I said, before theta starts to ramp that volume down, because as the buyer, we want the value up and we don't want theta to hurt us. Just like entering this trade, you can close them at the same time, or you could just close the short leg and then in a couple of days close the leaps. It's really up to you. And at the end of the day, what will be the overall profit of this poor man's covered call? It is going to be the value of the long call when you close it. So how much do you sell to close? How much do you collect? Did you win? Minus the premium that you paid, right? So it's a net on that leaps option. And then we're going to add in any premium that we collected from the short call. That's going to be your profit in this situation. Side notes before we get out of here, there's always one. There's going to be somebody that doesn't even watch this long in the video and they leave it in the comment section below. I promise when it happens, I will pin it. Oh, this is a great strategy until the stock price tanks. Everyone's always worried about this stock price or this crash and what's going to happen. Well, fact of the matter is, if the stock that you choose can tank, I mean, any stock could, but we know the ones that are less likely to do so. If it tanks, you lose, right? We're trading options. This is not a high probability of profit situation, okay? Yeah, if the stock tanks, I'm going to lose. And you will too. You need to know that going in. Everyone's so fearful, okay? If you do, like I said, if you check the boxes in your strategy, you are going to limit and mitigate all those losses. But yeah, if the stock price tanks, you lose, just like with any other option. I don't know why it has to be such a big deal. And the fact of the matter is, just like when we buy the dip, when our share price tanks and we own stocks, we can do the same here. If it's a year from now, and right now, I even was deep in the money, it cleared deep in the money, and now it bottomed out. Well, it was a stock that I believed in, and I probably should believe in it in 365 days from now, unless there's terrible news that came out about it. I could buy the dip again. I can buy another leaps option and ride that back up and let it rebound over the next year, just like I would if I own 100 shares of the stock and I had to hold on to that stock and wait for it to rebound. It's not like I'm allowed to make one leaps option and that's going to be the last thing, and if the stock goes down, it tanks and I lose all my money. No. If it goes down and you're worried about your leaps option, sell to close it and open a lower one and lower your basis. It's as simple as that. Like, it's not always about what happens if the stock price tanks. Yeah, I'll lose money, but I'll buy another one and I'll buy the dip. Next one I hear all the time is what happens if the short call does get assigned. Maybe it gets assigned early. It really depends on your broker, okay? Most of the time, this is general, your broker is going to exercise your leaps option to cover the assignment of the short call. Now, in some cases, depending on your broker, especially if assignment happens early, that broker might notify you. It might allow you to buy 100 shares to cover it. It might allow you to put in the money to cover the short call. It really depends. This is why you must read the disclosures when you enter brokerages and you enter options. Know all of the possible scenarios that are going to happen at the end. Once again, I talk to so many people that are so mad at Robinhood, and then I send them a screenshot from their terms and conditions, and it's clear as day. Know your exit strategies. But if it does get assigned and the broker does automatically exercise, where's your profit there? Your profit there is going to be the difference in strikes times 100 minus the premium paid plus the premium that you collected. And last guy is keep learning, right? The reason I had to make this video is because I've learned since I made the last one. You'll learn things about implied volatility and Greeks as you become better, right? I'm not a professional, I'm far from it, but I keep on learning and I get better and I make more money every year, pretty much at over 120%, I think the last time I looked, over the last year just trading the poor man's covered call. And I really am confident that you can do the same. Everyone in my Discord is saying the same exact thing. There is a link for that. If you're interested in jumping down and talking to a group of 400 like-minded individuals, including myself, with all my options trades, everything I'm doing. And yeah, I learned so much from my Discord. It's dope. If you like this video, guys, please give it a thumbs up. If you're new to the channel, consider subscribing. Almost at 100K. That's going to be a sick party. Believe that. I'll leave some other videos around here that you could check out that were relevant to this video. And until I see you on the next one, guys, stay positive. Work really, really hard. Always, please, be kind to other people. I hope you have yourself an amazing day and even better tomorrow.